Welcome to Master Trader, where you learn simple market analysis to make money investing and trading in the markets. I'm Dan Gibby, Chief Option Strategist, and wanted to give you a quick lesson here on how we approach trading volatility. So if we do get a market crash, like many are believing, you will be equipped and know how to act properly in the moment. There's a lot of talk recently. Here is one headline I just grabbed. Will the stock market crash in 2018? I just was watching Fox Business News just a few moments ago, and they were interviewing this John Gordon, historian, and he says he seems very confident that world markets are headed for some rough waters and hence some big market sell-offs. We don't care about those opinions because we teach and we analyze objective information that tells us how to react in the moment. So we don't have to get caught up on outlandish opinions, whether they're ultra bullish or ultra bearish. We don't care. We just trade the charts. The CBOE Volatility Index, VIX, that's what we're going to be talking about here. The volatility index rises with market fear and uncertainty. But the problem is this is an untradable instrument. So if you are believing that a market crash is coming, you can profit by buying volatility products. As you can see here with these arrows, this is a weekly chart, the S&P 500 ETF on top, and this VIX, VIX, on the bottom. And you can see that every time the market sells off, every time the VIX rises, and that's the time to buy volatility. Since I can't trade the VIX, what can I trade if I'm bullish on volatility? You can trade the VIX futures, and that's a contract based on the forward 30-day implied volatility of the S&P 500. Volatility ETFs, which are based on the VIX futures. The most popular and liquid ones are VXX, and UVXY is a levered, ultra short VXX. There's inverse volatility ETFs that aren't as liquid, but that you could look at those also in terms of bearish strategies if you're bullish on the underlying VIX products. But not all of those are optionable either. We just focus on these. You can trade VIX options, and that's also based on the VIX futures. One caution though, all of these VIX products create what's called contango, which just think of it as headwinds. And those are caused by the fund manager of these ETFs having to continuously roll these VIX futures and rolling them to more expensive months because time costs money. So if you sell it today and have to reopen that position 30 days later, that's going to cost money by definition, and that creates a drag on these products. So you have to time your bullish entries with very much precision, or else those headwinds are going to hurt you. And in fact, we actually teach many bearish strategies on the VIX for that exact reason. As I promised you, I want to show you, I refer to it when the fire alarm goes off, that this is an excellent strategy to profit on the market crashes because these volatility products have a tendency to rise very rapidly in the middle of fear and uncertainty. What are some bullish option strategies on these products I just told you about? You can buy it. You can buy those ETFs. You can buy the futures. You can buy the options. Swing trade them based upon the chart patterns. They all have pluses and minuses, so you really need education before you do that, so you aren't suffering from, these headwind components. Bullish option strategies, which we actually prefer because we know how to pick the proper option strategy to put the odds in your favor. So we teach all bullish option strategies, and bearish for that matter. We trade off the chart patterns on multiple time frames of the ETF. My favorite's the UVXY. We time it with the S&P 500 ETF and market internals, when they're suggesting a short-term top or bottom. You could buy long call options. The benefit of that is they give you leverage, limited risk. Whenever you buy options, your maximum loss is whatever you paid for it. Buying long calls is going to have high returns if you get your timing right and volatility moves up. Long call spreads. You buy one call and you sell an out of the money call to help pay for these long calls. The only slight downside is you are capping your maximum gain, but the huge benefit is you're increasing the probability of profit by making this long call investment a lot cheaper. Here's another strategy we teach when you're bullish on the underlying. Bull put credit spreads. You profit from time decay by predicting a short-term bottom in the VIX. So I'll show you on the next chart. What we do there is, once we have a bullish pattern on these VIX ETFs, we sell an out-of-the-money put spread on them. So the premium we receive for doing that is 100% profit, provided it expires worthless, which means above the short strike. What makes volatility rise? Here's the VIX again, daily chart. It rises on increasing fear, uncertainty, and demand for downside protection. When people are fearful, they go to the option markets to buy puts for protection, either for speculation or hedging purposes. So that makes the options more expensive, which causes volatility to rise. This is a wide range breakout bar through resistance. That's telling us it's time to buy volatility. And just wanted to show you here, this is what's called the implied volatility rank, and it shows you that the volatility levels now are at the 97th percentile highest that they've been over the last trading year. People, this is showing you that people are getting fearful and wanting to get bullish on volatility. Again, we use the charts, UVXY and the spiders. Here's a daily chart of the UVXY. You can see these products, you really have to master your timing because of that drag I was telling you about, those headwinds from contango. You see this is in a nasty downtrend. It broke down, big bottom, 100% retracement to this, then wide range breakout. This is a perfect time to buy your bullish volatility strategies that I just reviewed. Again, if the out of the money calls, they're cheaper. They give you a high return on capital for big moves. You're going to get paid for your bet. In the money calls, it's going to have less time decay from those headwinds, and you're going to make more total dollars on moves up, but the in the money calls are going to cost you more. A bull call debit spread is another bullish directional trade that we teach. So that's buying an in-the-money call and selling an out-of-the-money call. And again, even though that caps your gains, it increases the probability of profit of the trade ending up at a profit for you. Just wanted to tell you about, we have, if you go to mastertrader.com, education tab, we have a phenomenal webinar that's 100% dedicated to trading these volatility ETFs and options. So if you're serious about wanting to perfect this strategy, this is an amazing 4-hour course, 65 slides, and it teaches you the proper way to buy and short volatility. Finally, we have a free webinar coming up, and it's called Profit from Trading Stocks, Options, and Volatility in Market Crashes. So you're going to learn more about how to trade volatility, but also stocks and options when they have their own mini crash. This provides us awesome trading and income opportunities all the time. You're going to learn the patterns, the crash patterns on the stocks and broader markets, and then how to profit from trading stocks, ETFs, options, and volatility. Put it in your calendar. Next is February 8th, right after the market close, and I put the link in the comment section below. Go ahead and sign up for it, and you will be very impressed and learn a lot. That's all for this video. Please subscribe to the channel if you want to continue to gain knowledge on trading and investing in the markets. Happy trading, everyone. See you next time.